In this video, we're going to talk about the role of the GSEs, the government-sponsored enterprises in the mortgage market. And when we talk about the GSEs, what we're referring to is Fannie Mae, Freddie Mac, and Ginnie Mae. And so these three entities are entities that are kind of backstopped financially by the federal government. And now, actually, all three of them are operated by the federal government too. We'll go into that history a little later. Before we talk about these entities, though, it might be helpful to talk about just some very high level numbers and figures to give you a sense of the order of magnitude of the US housing market. So if you took all the homes that are in the US and you added up their Zillow value, and we're using Zillow as just kind of a proxy for how much the houses are worth. Zillow's, the website Zillow, the data they provide is basically an estimate of how much houses are worth. So if you took every house in the US, every apartment building, everything that's on that website, you added them up, it's going to be 52 trillion. Okay. So just to give you some sense of the order of magnitude of that, if you added up every company that's publicly listed in America, this is like Apple, Google, Amazon, if you added all of them up, and this goes all the way from Apple, Google, ExxonMobil, to all the smaller companies that are listed, it's around the same as this. It's around 50 trillion also. So this is a massively valuable kind of asset that the country has. It's residential real estate. And again, this is just residential. This does not include the office buildings, the retail space. This is just residential. Now, depending on your data source, I tried to kind of verify this or like look for the source data. It's kind of hard to figure out exactly what the number is, but I think we're just trying to get a sense of the order of magnitude. There's around $20 trillion of mortgage debt. And again, this is the value of housing. And there's 20 trillion in mortgage debt. This 20 trillion includes apartment buildings too, so multifamily. The designation is typically uh, 1 to 4 units is kind of considered owned by smaller individuals, and then above 4 units, it's considered kind of commercial real estate. These are like considered apartment buildings. So this 20 trillion includes this 1 to 4 unit categorization, of which most are 1 unit. Like when you buy a house, it's only one house on the lot, but you may buy a duplex, a triplex. These are all up to 4 units is kind of considered in the same category, and then above that is apartments. So this 20 trillion includes apartments and the 1 to 4 units. Now, the GSEs, which are very, very involved in the 1 to 4 unit category, that's kind of their primary business. They are responsible for the financing of 10 trillion. And if you broke this 20 trillion out, it's around 14 trillion is for this 1 to 4 units, and then 6 trillion is for apartments. So if you just look at these two, the GSEs are responsible for the vast majority of this 1 to 4 unit kind of mortgage financing, 10 trillion of the 14 trillion. Okay, so for the common person who's just trying to buy a house or a condo and getting a mortgage, the chances are is that your mortgage is ultimately going to be in the hands of these GSEs, okay? Because they're the most dominant kind of lender in that space. And we're going to talk about exactly how they are involved in this kind of residential mortgage market. Okay, so let's talk about just some terminology. So the primary mortgage market is when you, as an individual, are trying to buy a house and you need a mortgage. So you'll go to a bank or you'll go to a specialty lender that does residential mortgages. Like if you search online, Rocket Mortgages, it's like an online. It's not really a bank like Bank of America or Wells Fargo, but they are a mortgage lender. So there are many companies like that that are just mortgage lenders to people trying to buy residential real estate. So this is the primary mortgage market where you, the borrower, are interacting with the lender, and a mortgage is created when you kind of borrow the money to buy a house. The secondary mortgage market is basically that lender, Wells Fargo, Rocket Mortgage, whoever gave you that lender, if they've given you a 30-year mortgage, they may not want to hold on to that mortgage for 30 years and just collect your payments every month. They have the opportunity to take your, let's say, $300,000 mortgage and sell it to some other investor. Okay, so that other investor will basically pay, $300,000 to Wells Fargo. They now kind of own your mortgage. So you may continue to pay Wells Fargo every month, but Wells Fargo is going to pass that money through to this person they've sold your mortgage to. So in the end, that person is kind of the person collecting the interest and the principal that you're paying every month. So this is a secondary mortgage market where the primary originators, the originating lender, is able to sell the mortgage to some other investor. So the GSEs are, when it comes to this category of 1 to 4 unit residential, they are, as we saw, the predominant buyer. Okay, they are the ones that are in the secondary mortgage market, buying up all these mortgages from the originating lender. But they're not going to just buy any old mortgage. Okay, they are going to specify certain underwriting criteria that have to be met in order for them to want to buy the mortgage. So these are things like, minimum credit score of the borrower. We talked about DTI, that ratio of debt to income has to be, below a certain threshold because you want the mortgage borrower to have sufficient income to support the debt. They're going to require appraisal. There's going to be certain standards that the GSEs have in their kind of specifications in order for them to buy the mortgage. So most originators whose goal is to sell their mortgage to the GSEs, they're going to have the same kind of underwriting standards and criteria across the board because the GSEs have kind of set these standards. And so, since they're the largest kind of participant in the secondary mortgage market, most originating lenders who basically want to participate in that market are going to follow those guidelines. So that's why if you go to Wells Fargo or uh, Chase Bank or Rocket Mortgage, they're going to probably underwrite you in the same way because they're all following these guidelines set by the GSEs. So that's why the traditional mortgage, when you hear this terminology, conventional mortgage or conforming mortgage, what they mean is that they're conforming to the standards of the GSEs, or they're conventional in the sense that these are the standard mortgage underwriting criteria because the GSEs have set that and they're kind of the ones that are financing a lot of residential real estate. So what does the GSEs do? They don't just buy the mortgages in the secondary market and hold them for 30 years. What they do is package them up into bonds and sell those bonds to investors. Okay, so they are involved in these securitization transactions. And we're going to talk more about mortgage-backed securities and securitization in another slide here. Fannie and Freddie were public companies until 2008, so you, as a just a retail investor, could have bought stock in them, and they're kind of a monopoly in many ways. So they were very profitable for a long time. But what they do in this mortgage-backed security market is provide guarantees. Okay, so in order to entice the bondholders to buy these these loans, essentially to very small borrowers like you and me, um, and are 30 years long, uh, most bond investors are going to kind of shy away from that because they don't want to take the risk of, just common everyday people who they can't really verify themselves, and it's such a small loan. So what the GSEs do is provide a guarantee. They say, hey, if any of these mortgages go bad, no matter how much they go bad, we're gonna cover the loss for the bondholder. And so this is a guarantee that these GSEs provided. And during the 2008 financial crisis, so many of those mortgages went bad and weren't able to kind of recoup the money that the GSEs just had these massive losses. And the federal government basically had to step in because they've always kind of operated with the implicit guarantee that if they like their guarantee that the GSEs were giving for these mortgage bonds was backed by the federal government. So when the losses became really bad during that kind of real estate crash, the federal government had to step in and actually take them over to make good on those guarantees that the bondholders kind of were expecting.